Hi and welcome to Random Rogers Big Picture for the week of, when is it here? October 7th, coming up on Sunday. So, just one thing on the menu this week. This week was a pretty good start to the quarter, I must say. It's always nice when portfolio goes up. Hopefully you're participating in that as well. Someone left a comment that I thought was interesting, that I wanted to kind of go over with a little bit, because I think it addresses a couple of common things that people either don't do in the most efficient manner or maybe need better help understanding, or what. Take it however you want, but I just thought it would be a good thing to go over. I am retired and have all of my money in a portfolio representing about 60% as risky as the S&P 500. I believe this 60% risk allocation is quite similar to a typical pension fund, which is designed to last forever. Is there any argument saying it's not true? Okay, so I'm not sure how old this person is. I'm not sure how much money he has relative to how much he needs, or any of those details. But so I take that 60% as risky as the S&P 500. I'm taking to be 60% in equities. So assuming that that is what he means, it's worth kind of exploring whether or not he is taking, enough risk or being, too risky or not enough, or too conservative. There we go. Easy for me to say. So the thing that, and this is something I've touched on before, that people struggle with is they think that when they turn a certain age or hit a certain life milestone like retirement or whatever, that they need to pare back on their equity exposure. And this isn't necessarily the case. It really depends on the circumstance. If you're 60, you're just about to retire and you have just enough to get by, chances are you don't have just enough. If you know what I'm saying. You're relying, in that scenario, the person is relying on too many things going right, which is kind of a tough place to be in. We've talked about this before, but using the postage stamp, and I still have that chart, I'll put it underneath the video when I publish it, using the postage stamp inflation rate as a kind of a proxy for your household CPI over a period of quite a few years, not a quarterly thing, obviously. That's what your expenses are going to do. 10 years from now, realistically, you're going to, it's going to cost you 50% more than whatever it is it costs you now. And that's generically speaking. Health costs, we know, are going at a higher rate than that. Food, if you buy into the commodity food theme, then you have to expect that food is going to go up at a higher rate than that. Energy, I don't know that it's going to go up at a higher rate over a 10-year period. Maybe over the next 3 or 4 years it will, but you get the idea. So this postage stamp chart that's down below may be too conservative. So you at 60, and if hopefully you're healthy at that point, you need to plan on a pretty long time horizon. If you're 70 and you're healthy and your parents made it to 90, you see where I'm headed. All of these things matter. You need to plan on a fair bit of growth, especially if you're, have a 6% income need out of your portfolio. We've kind of joked about that before. 4% seems to be a pretty good number for a very high probability of success. Yet everybody we know needs a 6% drawdown. You know what I'm saying? So now there will be comments left invariably about, hey, but what if you're about to retire and the market cuts in half? Well, the short answer is, if you do nothing, yeah, you've got a problem. I mean, this is about, being proactive with the portfolio. I write too many times about some sort of defensive plan. For me, that's when the market goes below its 200-day moving average, beginning to, scale out, try to miss a big chunk of down a lot if it happens. But you need to do something. You can't. The assumption here is not that you're just sitting on your hands, maintaining, a 70% exposure to equities forever without doing anything differently. That is certainly not what I'm implying. As far as this person's comment about the pension fund, which is designed to last forever, yeah, that's true, but that implies to me that it can withstand a 50% hit in the market much better than you can. Also, I would expect that a pension fund is going to get much better results than any of us are going to be able to get. Maybe not, who knows? We're trying anyway. So, I mean, this gets very tricky. It is just a common thing, though, and this is an important point. It's just a common a thing to be too conservative as it is to be too aggressive. If you're 60 and healthy, you need growth. You can argue with that all you want, but I'm telling you, you need growth, and that's an important thing, and that's why I probably said it 3 times now in this post. So something to hold on to. Other than that, really not much else to say. Hopefully the market keeps going up. I continue to lean the other way sentiment-wise, and glad to be wrong as it goes higher. I just got the email for the ticker sense. I don't know if any of you have ever looked at that, but I've been bearish every single week, pretty much wrong every time, which is, good news. That means portfolios are going up, which helps everybody, and that should be obvious. Okay, lots of baseball, lots of football. Have a great weekend.